Welcome to the daily update, where I'll go over the action in the market for Thursday, June 27th, and then we'll see how things look for Friday, June 28th. Incidentally, I'm recording this not too long after the presidential debate just ended. There could be some shakeups going on there, especially on the Democratic side. The initial response was that things did not go very well. That could add a little bit to the political instability. The futures are up right now and really didn't fall much after that, because from a stock market perspective, it really doesn't matter if there's a Republican or a Democrat. They have friends on both sides. So I don't see that really having an impact on the market. But it's going to be the pop news and what's going to be dominating the headlines. Looking at the stock market, we're still positive and we're hanging in there. We're not seeing selling into strength. We're not seeing a real improvement with the internals, though, either. The mega caps ended up doing a little bit better, even though they're kind of mixed right now. But the big issue is going to be in Friday's session. The core PCE will be coming out. That's the big inflation report. There might be some real reaction to that. Friday is also going to be the last day of the week, the month, and the quarter. It's also a time when there could be some window dressing going on. So we're still looking okay. We're still looking positive for right now, but we're also looking vulnerable at the same time, as the market has been chopping sideways for the last number of sessions. Please know that at least for a few more days, the SPX Investing Program, it's freely available. You can go to a link in the description to get access to the website if you want to learn more about the program. There's a playlist on YouTube. There are also videos on Rumble. You can email me if you want to talk more about this. I will be locking it down July 1st. So this is kind of a chance. Now, I'm going to be rolling out a lot of additional things after July 1st. Just for example, there's a chart that I'm going to show later on about the petrodollar. Well, what does that mean? And they're talking about, one side is like, oh no, this means the death of the dollar, since Saudi Arabia is now not sticking to that agreement. The other side saying it just was an agreement. It wasn't a formal agreement. It was like a gentleman's handshake between Saudi Arabia and the US, and it's not going to be that big of a deal. There's both sides to that story. I'm going to be doing some more research on that, and then probably doing a supplemental video about that, in addition to having first access to the daily videos. And there's other things like portfolio ideas. And then I'll be posting publicly about how we're doing with a lot of the actual positions that we go through based on the program that I teach. The first class is posted there. It's freely available. It's the same class that's on YouTube and Rumble, but that's about 3 years old. I re-recorded it and made it available. I'll be rolling out another course that I'm just starting to record right now about technical analysis. Then after that will be a strategies course. And then after that will be a mental analysis course. That's to give you the foundation. The daily and weekly videos are to see the foundation played out in real time. You take that, then we come up with different strategy ideas. And then at the same time, we're trying to get our emotions under control. And that's, in a big picture view, that's pretty much the program right there. All right, let's go back and talk about what happened, and then I'll go through some charts. We had pretty much a flat open. The futures were coming down a little bit. They had been a little bit more positive, but it was pretty much flat by the time we opened. And prices immediately rose up. We hit resistance at R1 at 54.90. Then we fell back below the unchanged level to go negative, and we found support at the daily pivot at 54.71. We climbed back up above the unchanged level to go positive again, only to fall back negative, and we found support again at the daily pivot, and we closed slightly positive. We were able to bounce up off of that and have a slight up day. So we were up 0.09%, virtually unchanged, but as I usually say, it goes in the books as an up day. We actually dropped a little bit below average with volume. This could be some anticipation ahead of Friday's economic reports. And then we're still looking okay in the short, intermediate, and long term, but we are seeing some vulnerabilities. We're not seeing an awful lot of strength. It's going to be more about inflation and interest rates on Friday, because that's the other big inflation report that'll be coming out to see if our scenario will in fact change. Some comments, mega caps, they had a better day, and this was pretty much a ho-hum session. Below average, we chopped sideways, not a lot of conviction. The negative divergences, which look like they were getting better, are still there. They improved a little bit after Thursday's session, but not very much. We're not seeing an awful lot of strength there. So we still have to realize those negative divergences are there, and I'll point those out as I go through the charts. And the strength, it looked like it was okay. Is this getting better again? We look like last Friday and Monday we had down days for the S&P, but internally we were seeing some strength. Then we had a few up days for the S&P, and that strength seemed to be going away. Well, it showed a little bit of an improvement in Thursday's session. On a short-term basis, we are still extreme positive with the Williams percent R, the stochastics charts, and the RSI based on 9 periods. We're still just extreme with the RSI based on 14 periods in the intermediate term. The scenario is still pretty much the same. They're looking at potentially one rate cut in September now, and we don't even know for sure if that's what's going to happen. This is just what the market is thinking will happen. We'll have to see how reality ends up actually playing out. The dollar was down and interest rates were down. This is kind of what helped stocks remain positive. We closed at 4.29% for the 10-year yield, where after Wednesday, we were at 4.32%, still inverted with the yield curves, and we've been that way, at least with the 10 to the 2-year for over 2 years now. Sentiment, we're showing a little bit of improvement. We've gone from being negative up to neutral, where we had been at 41, that's negative, and we came up to 46, where that is more neutral. And we are positive with the trend. It's kind of strange that we've been chopping sideways. You can clearly see by looking at the bar chart that we've been not really trending all that much, but the ADX is still picking up that we are in a trending environment because we're above 20 and it's above its moving average. With the up day, we're positive. I'm still keeping momentum at mixed. There might be some anticipation building up to Friday's session because of this inflation report, and we'll see how the market ends up reacting to that, either positive or negative. The economic reports that came out, some of these I'm just going to read off the numbers here. These aren't really influential. The advanced international trading goods came in at minus 100.6 billion, which was more or less, you could say, a stronger negative number than the minus 98 billion we saw last time. The retail inventories were the same as last time, up 0.7%. Wholesale inventories were up a bit more, up 0.6%. Last time they were up 0.2%. Here's where I have some charts to show you. The jobless claims came in at 233,000, less than the 238,000 that they had expected, and down from the 239,000 that we saw last time. The continuing claims are actually ticking up a little bit. They had been at 1.821 million. They went up to 8.839 million. Durable goods, this was kind of a biggie, but it didn't have as much of an impact on things. The durable goods orders were up 0.1%. They expected them to be down 1.2%, where last time they were up 0.2%. And if you take out transportation, they expected it to be down 0.1%, or they expected it to be up 0.2%. It was down 0.1%. Last time it was up 0.4%. Not a real big change. In fact, we came in a little bit stronger with the third estimate of GDP. Last time it was at 1.3%, which is what was expected. This time it came in at 1.4%. Nothing all that great, but still positive. The deflator came in as expected at 3.1% and up from the 3% that we saw last time. Pending home sales were down 2.1%. They expected them to be up 2.3%. Last time they were down 7.7%. Here are the weekly jobless claims where we came down with the raw number from week to week. The moving average is still continuing to go up. And we're going up both with the moving average and with the number here with the continuing claims. And this is suggesting possibly some weakness in the employment situation. Here's taking everything together. The blue line, that's the continuing claims. The red line are the initial claims, and the black line is the latest unemployment report that we received. Now, we'll be getting another one at the beginning of July, so this will definitely be updated. Here's a look at that same chart, just to give a little bit more. You can see it a little bit easier here when I blow it up. Durable goods on a year-over-year basis are declining. Over here, we're slightly below zero. When you take out aircraft, we're also just a little bit below zero. Month over month, we were positive, but we have been declining as of late. And the real GDP and the deflator, where the GDP, that's the blue line, it's going down, but it's still above zero. The deflator is going up, but that's showing a slight increase of inflation, but not all that dramatic on a quarter by quarter basis. And then looking at personal consumption year over year, we are coming down, but we're still above zero. The net exports, which are always negative, they're seeming to be just a little bit less negative now. And then real GDP year over year, where it is coming down a little bit, but it's still positive. But we mainly look at the quarter over quarter readings, not so much the year over year. New home sales were down, but not as much as we saw last time. This is a chart of kind of showing that same thing. It's just showing on a seasonally adjusted basis how we're getting to really, really low levels here. And this is a little bit more scary chart than the previous one we just saw. Some Isabel Net blog charts. This is the deviations of earnings either above or below long-term growth trend. We're in this red area and continuing to go up. So sometimes this may suggest on a longer term basis some concern. And then putting 2024 in perspective, it's what with the S&P 500, the index max pullback per calendar year, we've had so far a decline of 5.5%, but other times, we've been up 5.5%, but other times we see some pretty significant pullbacks here, even above this green line. We really haven't had that big of a pullback in 2024. We got weak there for a bit in April and into the early part of May before we bounced up out of that. But we haven't seen anything all that too significant, where the average is when we have a pullback, you could actually get that into correction territory, is down 14.2%. And then declining short interest, this could be a bearish sign because, yeah, when it's going up, that can also be bearish because a lot of people are shorting the market. But when this gets really low, the point that I like to point out is that there's not a lot of built-in buyers on the sideline. A lot of people are just expecting the NASDAQ 100 to go up. Usually we follow the S&P. This is the NASDAQ 100, and this is just continuing to trail off as the NASDAQ 100 has been going up. And then here's another one of these crazy charts, the index weight of the 5 largest companies. It had been falling as we were seeing a little bit of weakness here, but now it's starting to come back. And then hedge funds. Now, I always say hedge funds. They might be the big money because they have billions and billions of dollars, but they may not necessarily be the smart money. And sometimes it's a little bit hard to tell the difference. We want to follow the smart money. That's what really controls whether the market goes up or down. And they are seeing an awful lot of outflows here. A lot of money coming out currently. And then the equity allocation, we're at 62% right now, where it's not quite as high as what we've been at before. And then the share of the total S&P 500 cash use, we're here for CapEx, capital expansion, and research and development. That's actually coming down, and they're projecting it to continue to fall. Actually, this is the dark blue line. They're actually expecting it to go up and then trail off sideways here. And then the dividends and buybacks, they're seeing that is actually declining now, where some of the other charts that we've been seeing, they're not focusing so much on dividends, but we are seeing a real increase in the buybacks, but they're projecting that to continue to fall. And then mergers and acquisitions here, they might see a little bit of a pickup there going forward. And it's usually in strong stock market or periods when you see one company buying another company. You'd think it would be opposite of that. If you're going to go out and buy another company, why not do it when the prices are lower? But it tends to work. Okay, we're doing really well. Let's go buy something. And then passive equity flows. And I deal with this in the course, the basic course. Passive funds follow an index like the S&P 500, maybe a mutual fund, or the SPY ETF, or the NASDAQ 100, which is the QQQs, or you can get into NASDAQ 100 mutual funds. Those are passive, meaning you don't have to do anything to manage those. Whatever The index is made up of those stocks. That's what are in that either ETF or mutual fund. Where active management, that's when you have this real smart rock star type of mutual fund manager who's supposed to uncover all these gems. Well, when we're going up and we're in a solid uptrend like we have been since October of 2022, passive types of investments tend to do better. When we're chopping all around like we did in 2022, that's when we tend to see the active funds and active ETFs, I guess. Like ARK would be an active ETF because there's actually some maneuvering that's going on there. Well, they tend to hold up a little better. And of course, that's not a good example for 2022, but as taken as a whole group, because active types of investments, the person managing those has a little bit more latitude. They can go into more defensive stocks. They can try to find gems even in a down market, where passive, you're just dealing with the indexes and they're just the same no matter whether we're going up or down. And so we've been seeing where passive funds have been actually outperforming and seeing more equity flows into that, and they're projecting it out on an annualized basis. And that's typically what we see in a bull market. Couple of charts here. This is hedge funds are selling technology stocks at the fastest paces. Okay. At the fastest pace since at least 2016, according to Goldman Sachs. This could actually be somewhat positive for the market because they've been getting out thinking, oh, this run is over. So they're getting out of these things. And now that could actually bring in some buying. But looking at this just at face value, that you would think that this would be more negative. This is what I'm talking about with the petrodollar. A lot of folks are out there. They've been hearing about this in the news. They really don't know about it, even though it's been around since the early 70s. And so they're going to Google and they're searching the word petrodollar. And this is what happens quite often. The day after Britain voted to leave the EU, which we call Brexit, right after that was the most number of searches in the UK for what is the EU. So, these types of things do happen. All right, let's look at the intraday chart. We were pretty much flat at the open, but quickly saw an upthrust to R1. We weren't able to get above that, but we came back up to this level a few times. But then we went back down below the unchanged level. We found some support right around the daily pivot, tried to go positive again, fell back down to the daily pivot again, and then saw a little bit of buying going into the close, which ended up giving us an up day. Nothing really much to show you here on the intraday chart. We're not seeing these really massive swings or real big changes while the market is closed, but we're still looking positive here. The blue line is still above the red line. That means growth is outperforming value on the intraday chart. And when we look at our ratio, even though it came down near the end, we are seeing an improvement with the growth to value ratio for the S&P. This is showing some hope here. Our end of day charts, growth was up where value was down. We were up a little bit more with the mid caps and up less for the small caps. So in our end of day charts, seeing a little bit of an improvement here with the small cap growth to value ratio, little teeny tiny tick up with mid cap growth to value, and a little bit of an improvement in trying to break out above this previous level. This is more encouraging right now to see this chart going up. That keeps us a little more positive on the market. And when we look at the different ETFs, the growth ETF is clearly outperforming the value ETF. So that's also giving us more hope. Not seeing much of an improvement here. We ticked up with the ratio, but it wasn't because discretionary did all that well. It's because we've been seeing a decline in staples recently. Large cap growth, just coming off of setting an all-time high, fell back, and now we're getting close to that all-time high again. Large caps continue to outperform small caps, even though we did pull back a little bit in Thursday's session. The Wilshire's been chopping sideways, but just setting recent all-time highs. Our trend is still suggesting that we are trending. The concerning part is that the green line, even though it's on top, has been coming down. Now it's starting to level out. If we can have a good solid up day on Friday, that would turn the green line back up. And we're seeing pretty much that same thing, a little bit of a turn up here with the green line on the short-term ADX. We did drop a little bit below average with volume. And sentiment, we're kind of chopping sideways, but under the moving average with the Ulcer Index. We did get the reading yesterday from the Investors Intelligence. They came in at 3.32. That's above the 3 level, not necessarily extreme. And with this slight update, we did decline with the closing value of the VIX. We're also declining with the bar chart as we're seeing fear coming out of the market. So with the slight update, we declined with the VIX of the VIX, with the bar chart, as well as the line chart. We're falling below the moving averages now. And we're chopping sideways recently with the VIX, and the MACD is starting to pick that up and could be getting ready to roll over negative to show the momentum. But for right now, it's not negative yet. And we are seeing kind of a series of higher lows right in here. But we're also seeing a series of lower highs. So it's kind of like one of these triangle things that I don't use very much. This didn't update, so I can't really conclude much here. The last time we had a reading, the 5-period equity put call ratio was going down, which tends to be positive. We're coming down a little bit, but we're still quite high with the volatility risk premium, and we're well above this band. And this is kind of the opposite of what we're seeing in the VIX right now. We ticked down a little bit with this fear gauge, and we ticked down with this other fear gauge slightly. And we did get the latest reading from the American Association of Individual Investors. They actually became a little less bullish, so they're not giving us an extreme reading. But you follow the red line, and that's the 50-period moving average. That continues to go up. And here's where we're seeing some negative divergences. We have not been able to break it above this previous high with the advanced decline line based on price, and we actually ticked down a little bit. But on the positive side, we're still hanging in there when we look at the advanced decline line based on volume. And we're seeing a contraction of the new highs, no real expansion of the new lows, but it's causing our 5-period to go sideways. And now we're starting to turn down with our 10-period moving average. And we're looking a little bit more negative in the short term with the 19-day advanced decline ratio. We're slightly positive with the 39-day advanced decline ratio. This is still looking pretty solid for the time being. The accumulation distribution, we are above an advancing moving average and continuing to go up. We're also starting to go back up with the Chaikin money flow, and the red line is just barely starting to turn up. We're going back up with the Chaikin oscillator. And we're still hanging in there with the cumulative advanced decline line on the NYSE. We're still above this moving average. We're not really moving all that much with our regular NYSE advanced decline line, but we're still above the moving average. Also on this chart, still above the moving average with the other NYSE advanced decline line that we follow. So we saw a bit of a decline here with the NYSE common stock based on price, and a little bit of a decline based on volume, but not a real big move there. And we're still holding up better with the S&P advanced decline line cumulative based on volume. This is looking a little bit better, where we've been chopping around a little bit more, but not much based on price. And we're seeing a little bit of an improvement when we look at the S&P, that's the bar chart, and the red line, which had been coming down, that was showing a negative divergence. With this going back up, that's at least showing some improvement. And we're still below the moving average with the NYSE common stock for the advanced decline line, still above the moving average with the S&P, flat with the mid caps, and actually saw a little bit of an advance with the small caps, but both mid caps and small caps are below the moving average. So not really getting much from this chart these days. If we really shoot up, we'll be watching these pivot points to see if they provide overhead resistance. If we really start to fall, we'll be watching this pivot point here as well. And we dropped barely below the moving average based on volume. We're a little bit extreme positive with the Williams percent R. We're extreme in the short, intermediate, and long term with the stochastics charts. We're holding up here with our 20-period double and triple exponential moving averages. We're still kind of right at these lines, but they're continuing to go up for the time being. Saw a little bit of a tick up with the 20, 50, and 200-period moving average study just calculated on the S&P itself. The force index is still looking positive. We're still above the 20-period moving averages. We're not extreme with our standard deviations chart. We're in the +2 channel and have been pretty much all week. Intermediate term, we're going back up with the balance of power, and we're above 0. That's positive. We're still seeing the lighter shade of blue here. That's more neutral, where the darker blue, that tends to be more positive. And we're still looking okay, but chopping sideways with our highest high value chart. Still going up slowly, but still advancing and having a lighter shade of blue with the TTM squeeze. And still holding up here above the 50-period moving averages both the double and triple exponential versions, and this is continuing to go up, and the red line's above the blue line. That's what we've been seeing lately. So the intermediate term is holding up okay for now. The ease of movement continues to decline, but it's still above zero. The Erin continues to be flat, but it's positive. We did tick up with the S&P McClellan oscillator, but we're still below zero. So we are continuing to decline based on price and volume. When we look at the summation index for the S&P, we're also showing an improvement, but still below zero with the NYSE McClellan oscillator. So we continue to decline with the summation index based on price and volume for the NYSE. Actually seeing this going down a little bit faster, that potentially could be negative. And we're still positive here with the Swenlin trading oscillator, but now we're declining. But we're still above zero based on price and volume. And we're starting to flatten out with the PMO. This is a momentum oscillator. We're also turning back positive and looking a little better based on price, where we're still declining based on volume. So we saw a bit of a tick up with the PMOs that are rising. We're declining with the buy signals. We continue to flatten out with the PMOs that are above zero. And we continue to be neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. The slope is starting to flatten out a little bit, but we're still positive. You could also make a case for being extreme positive when we go above this green line. Now, I put the green line on here, so there's nothing magical about it. I use that mostly as reference. You could also say that we were going up with the S&P, but we didn't go up as much. So that's showing a negative divergence on a momentum basis. The MACD is coming right back down to its moving average. So it's just hanging in there, barely positive. And so we are starting to see a little bit of at least slowing down with our momentum oscillators with the slope. The TSI is still looking a little more positive. The MACD is on its moving average, a little bit above with the PMO, on the moving average with the PPO. Those are the intermediate term oscillators. Rolling over just a little bit, but still positive with the TRIX and the KST. These are our longer term oscillators. Still above all the plotted moving averages. Still looking okay here, but not great with the bullish percent index. We're above 50, so that means we're positive, but we're not really showing any strength. And we're declining, but still above 50 with the NYSE bullish percent index. We ticked up just a little bit, but we're positive with the NASDAQ 100 bullish percent index. The money flow is going up after it had been declining. We're above 50. That's positive. We're continuing to decline, but we're still positive with the ultimate oscillator since we're above 50. We continue to decline here with the vortex. The green line is on top, so that's positive, but it is declining. And the RSI 14 just barely extreme positive, as well as the RSI based on 9 periods. Since we had the update, on balance volume is still above the advancing moving average. And we're right at 50 with stocks inside the S&P that are above their 20-period moving averages. So we're right at a tipping point currently. So we were looking better with our study. Then we started to fall back. For this to continue to go up would be more positive for the S&P. And we're barely above 50 with those stocks above their 50-day moving average inside the S&P 500. Ticked up and above 50 with those stocks above their 100-period moving average, and pretty much flat here with those stocks above their 200-period moving average. The copy curve continues to roll over, but has not gone negative yet. Pring Fisher, for some reason now, still continues to generate a signal. No longer extreme with the Sean trend meter. And we're negative here with the 5-period moving average of the highs minus the lows. On the Amex, NASDAQ, and NYSE, we continue to be below zero. That's a broader measure negative look. And we're still above this line. This is more positive. We'll wonder if we can close above this R2 level. That would put in another weekly bar, or at least finish this one out. For right now, we're above this level, and we're wondering, can we stay above that? That would put 2 weeks in a row above this longer-term pivot level, which could have been acting as resistance. If we close above it for 2 weeks, it's not really strong resistance. If we fall, we're not very far from it, so it may not be likely that it provides support. Here is a look at the fib extensions for the S&P, where we came right up to this 50%. Now, I measure this, and one of the reasons I don't like these charts is you kind of have to fiddle around with this and come up with what you think is a good high or low. I had the low last October, and then the low set right at the end of March, early April. Yeah, I could have gone here, but we don't seem to get much of a reading that way. But this would be a lot more positive if we could come back and actually get above this 50% level. We're looking okay here with the Heiken Ashi. We have a slight open candle. We're pointing back up now with the Kegi chart, so that's positive. We're positive with the Renko chart, and we're positive with the 3-line break. And we're still seeing the negative divergence with the 150 and 200 period moving averages. We're no longer extreme. We were flat with the 200 and ticked up a little bit with the 150. We're still negative in the short term with the mid caps, and we're still negative in the long term with bonds based on price. No changes that I could see with the decision point scorecard. And we had one alert that was signaled when the NASDAQ, right after the opened above 17.8. That was it. And then we saw where real estate, discretionary, and communication were up. Energy was up slightly, utilities, industrials. Then we had staples that ended up being down on the day. Not a real decisive day looking at our different sectors. We've gone back to being a little bit more positive here with the new highs and new lows for the NYSE. We are back above zero. And we ticked up barely here with the equal weight, comparing it to how it's performing with the S&P 500 weighted index. So we came down a little bit here with this ratio. This going up just means that the mega caps are really outperforming. And the Dow is kind of going sideways now. We're still above this pivot level. It's really hard to see because there's that P right there. We're also above the 50-day moving average. So not really showing an awful lot of strength, but still hanging in there for the current time. We continue to be neutral with the diamonds for the Elder's Impulse system, and we're coming right up to this pivot point again. We want to be able to get above this point and close above it for the NASDAQ. This is acting as overhead resistance. We're also dealing with this pivot point with the NASDAQ 100. We want to get above this and then close above it to turn more positive. We continue to be neutral with the Elder's Impulse system for the Qs, but the momentum is now starting to turn negative. We're just not seeing enough follow through right now, and the PPO is picking that up and starting to drop below its moving average. And here's another fib extension chart for the Qs. We came just about up to this 38.2% extension. It's not a retracement. And this seems to be providing overhead resistance. Even though we've gone up the last 3 sessions, we want to get above this to turn more positive for the Qs. And here's the weekly chart. Not looking as scary right now. We seem to be repairing ourselves just a little bit. Now, this could all change. If we have a down day on Friday and this turns into a red candle and goes down, that could end up looking kind of scary again. Small caps were up 0.41%, but still range bound. And they've switched over to positive with the Elder's Impulse system with the small caps. Looking at the Russell 2000 small caps, we crossed back above 50 with the RSI. We got back above the 50-day moving average. We're still negative with the momentum, but it does look to be improving, and we're still in a longer-term uptrend. But none of this seems to really matter because we'll get to the high end of this range, and then that's when things will top out, unless we can really break out of this range. The mid caps, which had been stronger earlier in the year, just continue to chop sideways, still below their 50-day moving average. And they've gone from being negative over to neutral with the Elder's Impulse system for the mid caps, off of recent all-time highs here with the total U.S. stock ETF. Apple was up 0.4%, seeing now a relatively new uptrend. Still seeing a downtrend with Tesla, even though it was up another 0.5%, but still below its 200-day moving average. NVIDIA was down 1.91%, a little bit more profit taking there. But we were up slightly with Microsoft, setting a new all-time high. Meta was up 1.25%, not quite back to an all-time high here. Amazon kind of breaking out. It was one of the stronger stocks, up over 2%, setting another all-time high. Google also setting another all-time high on a closing basis. Netflix was up almost 1%, not quite back to setting an all-time high, at least yet. The FANG index, after declining, is now starting to show some improvement. This might be a new all-time high, just barely above the close that we saw a few days ago. Financial sector, we're just dangling around the 50-period moving average, but we're still in a longer-term uptrend. The staples to tech ratio is continuing to decline. That's what we want to see if we're more positive on the market. The dollar ended up being down, but we're still in a longer-term uptrend. And we're going back to the shorter correlation between the S&P and the world index getting a little bit weak. We're trailing off with the longer correlation as well. And when we look at the staple sector, we were down 0.43%, but we're still above the 50-day moving average. The momentum is starting to turn back up. That's the green line, and we're flattening out with the relative strength ratio. We're also turning back up with the momentum for the utilities. They were up and trying to bounce off their 50-day moving average, but still continuing to decline with their relative strength ratio. And we're still above the 50-day moving average, but chopping sideways with real estate, seeing a little bit of an improvement with the momentum and flat to slightly turning better with the relative strength signal there. Turning back up with the momentum with healthcare, but still declining with the ratio, the relative strength ratio, and we're still above the 50-day moving average. And then we were down slightly with the 10-year yield. That means we were up based on price. And we're seeing a little bit of improvement here with the Qs to S&P. We're so far been bouncing off of this moving average, seeing a little bit of an improvement here with discretionary to the S&P, but we need to see this stay above that and see the moving average turn up. We're also seeing an improvement here when we compare large cap growth to large cap value. So the large caps are improving, looking a little better for the mid caps as well as the small caps. And we're looking slightly negative with our 19-day advanced decline ratio based on price. We're slightly positive with the 19-day advanced decline ratio based on volume. And we're keeping the trend going up here with the S&P to utilities ratio. That's positive for the S&P. We're going back down with the staples to S&P. That's also positive as this declines. So what's our outlook for Friday? We are still positive. These negative divergences are still there. Some of these internal and broad market strength areas, yeah, some of them might be showing a little bit of improvement, but they're not showing an awful lot of improvement. We'll see if things get a little bit more convicted, either positive or negative in Friday's session. We're going to get personal income and spending, the core PCE, that's going to be the big one. We're going to get the Chicago PMI and then the final reading of consumer sentiment. And then all the different geopolitical events here. Of course, the pop news thing now is going to be about the presidential debate. But again, that really doesn't impact the stock market. And then we will finish out the economic calendar on the week and for the month. And here are the different previous readings for the core PCE. That's the big one as far as, and the Chicago PMI as well. Seasonally, we're neutral to positive across the board for June 28th, and this will be the last trading day of the month. We tend to be down a little bit more than up. We'll be finishing out the week after options expiration. Friday is one of the more positive days, so have that going for us. And we do see a little bit of positive seasonality going into the end of June during an election year. And this is the Carson chart also showing a little bit of positive seasonality as we finish out the month. Bigger picture look, also, we're starting to turn back up as we head into July. We could get a period of positive seasonality that way. And we're still in the last day. Well, I guess we're in the first day here. June 28th, we're coming into a positive time, but there's only going to be one trading day for this period of time that Tom Bowley has as being positive. Just looking at July, this is what I'll roll out next week as I do the videos. And then the NASDAQ's 12-day mid-year rally. This is what they're thinking might happen as we finish out June and then start to go into July. And then this other chart put up by Stock Traders Almanac, this pink or purple line, it's getting really far away from the green line. And so they're suggesting, are we going to revert back here to what the norm usually is? And the warning signs, we're still watching staples and utilities as well as energy and healthcare. The advanced decline lines, not really showing an awful lot of positive signs right now. We're still above the moving average with the S&P, but we would like to see this on a broader market measure. Growth to value is showing some improvement, but discretionary and staples, not. It's more of a weakness in staples rather than strength and discretionary. We're still negative with the NYSE and S&P, McClellan oscillators, and summation indexes, even though they ticked up a bit. The Q chart still looks scary. Now, there's still one day left, and anything can happen. This could go back to looking scary, but for right now, it's showing an improvement. And this is just new on this negative chart here. The NASDAQ 100 momentum, the PPO, is now crossing negative. But we still have a pretty long list of positive indicators with the parabolic SAR, the three smart money indicators, the accumulation distribution, Chaikin money flow, and Chaikin oscillator. They're still looking okay for right now. And the last I could tell, the equity put call ratio is going down. Our oscillators are positive, but rolling over a bit as we've been chopping sideways. We're still above 50 with the S&P bullish percent index, but we're not really breaking down, but we're not really moving higher either. The Swenlin trading oscillator, we are positive, but now it's been pulling back for the last couple of days. The money flow, the ultimate oscillator, the vortex, those are all positive, but the vortex, which is a primary indicator, that's why I have it as gold here, it's declining. The green line is coming down. The Copic curve is positive. The Pring bottom fissure, it's generating a buy signal. And the financial sector is positive, hanging out around its 50-day moving average. And the bullish percent index for the NASDAQ 100 is positive. It ticked up a little bit, but not showing an awful lot of conviction currently. So our conclusion, we're positive. These negative divergences are still here. It really hasn't changed the last few days. We're starting to see some more rotation as well. And we're wondering, is that going to be to the positive side or the growth side? Or is it going to be more to the defensive side? Is the strength actually going away? It improved a little bit after Thursday, but we need to see more follow through there. We're positive, but slightly overbought in the short term. We're still positive in the intermediate term, but the negative divergences are there. Watching rotation from sector to sector, and we're going to keep an eye on the strength, possibly coming back and seeing more follow through. We are still positive in the long term, but we're seeing that negative divergence where the 150 and the 200s were going down as the S&P was going up. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.